gas, but that was really what had everyone's focus today.
Absolutely. I mean, natural gas has been on quite a tear over the last month, I think up more than 50%, but earlier up and now down in a huge way. Vladimir Putin indicating that perhaps Russia will help out the situation so that there won't be so much of a supply crunch. I would make the case, though, that this wild ride in natural gas does reflect fundamentals, but maybe more so all of the Fed liquidity, because we've seen this playbook many times. Lumber, stocks, Amazon. To talk more about this, let's bring in Carly Garner of DeCarlyTrading.com. And Carly, with you, of course, I'd like to bring in your commodity and your options expertise. It's just incredible what we have seen with natural gas. And you also made the point around the natural gas VIX, or at least we have a 3-month implied volatility index, that it's off the charts. It's at a record high. What are you seeing here, and what have the last couple of weeks been for you as this wild trading action has been happening?
It's been beyond wild. Honestly, I've been doing this a long time, and I've never really seen anything like this. Essentially what we're seeing, I mean, there's really no fundamental reason. I mean, we can search for reasons, but there's no good reason for natural gas to be up 10% one day and down 10% the next. And we've seen that over and over in the last couple of weeks. It's really just irrational. And the only thing that can explain it is human emotion, and we're seeing that in the options market as well. There's a lot of emotional trading going on, which has caused the volatility index to explode to levels we've never seen. So as a result, it's basically a dysfunctional market. As the market explodes higher, both the puts and the calls gain in value, which that's not how it's supposed to work in textbook scenarios. So there's a lot of weird things going on, and in my opinion, it's probably going to force out all the speculation, which in the long run is a good thing. It'll calm the markets down and get things back to a more reasonable volatility level. So that's what we're looking for in the next couple of weeks.
Yeah, so that's really interesting, because you're saying that calls are super expensive. So that makes sense, because you have the speculators thinking that maybe this parabolic run will continue, although physics tells us that a 90-degree angle can't hold. So at some point, those speculators will get washed out. But if puts are holding the level, that does suggest that at some point it's going to be pretty painful for those speculators, based on everything that you know, even not having seen something exactly like this before. Although I'd like you to compare it to oil last year, because that was pretty wild, too. When do you think that perhaps we see natural gas start to calm down a little bit?
That's an absolutely wonderful comparison. I was actually going to bring that up. This is the opposite of what we were seeing in oil in March 2020, where everything just blows out, and then next thing you know, oil trades sideways for a month or so and then grinds higher. I think we're going to see something very, very similar. I think we see natural gas really just trade sideways for a little while and then start to dribble lower. I mean, since fracking became a thing here, in 2014, natural gas has really had a hard time holding rallies. It's just a matter of when supply will come back to the market and calm things down.
So, Carly, again, you're an expert on commodities and options, so we love what you've added for both here in natural gas. But if we stick with commodities, what I was talking about with Romaine earlier, the idea that, maybe there are some fundamentals, as you were saying, but you're also talking about arbitrage and short squeezing. But if we get down to it, all of the liquidity sloshing around in the system from central banks, we saw it hit lumber, stocks, individual stocks such as Tesla, cotton more recently, all of these different commodities. Are there any that have not yet ripped higher for people to potentially identify as the next pocket for liquidity to search out?
You're exactly right. People are looking to buy things because they're trying to hedge inflation, and unfortunately, all the things that they've probably bought this year have eventually not worked out well for them. To be honest, I think the natural gas was and crude oil were kind of the last ones holding out, and I think we're seeing that now. But so I don't really see any good buys on the board unless you want to look at metals. The silver and gold, ironically, haven't really participated in the liquidity fiasco, and so maybe they're next.
Great insight. It'll be interesting to see if gold and silver do get one sort of last gasp pushed to the upside, or maybe it will just be natural gas and oil as the last part of the commodity cycle higher. Thanks so much to Carly Garner for joining us for Options Insight today. And from New York, this is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Who are U.S. Open tennis champion Emma Raducanu's 3 dream dinner guests?
Daniel Ricciardo, Michael Jordan, and Tom Keane from Bloomberg.
She understands you.
Funny and very understandable.
I am reading in on tennis like nobody.
Yeah.
Champion approved Bloomberg surveillance. Mornings on Bloomberg Television and Radio.
We have no exposure to Evergrande, is the short answer. Our own strategy on China for the last several years has been built on building independent credit decisions and credit underwriting.
We had some breaking headlines after, of course, Joe Biden, the president, had plans a virtual meeting, of course, we understand, before the year end with Xi Jinping. We've got plenty of headlines coming across the borders to the ongoing discussions between China and the US and how they continue to progress. Let's get the inside track with Emerging Action Conversation. Sherry Ann, co-anchor of Bloomberg Daybreak Asia. And what have we learned about China-US relations? Because thus far it felt as though there wasn't much change in the Trump administration.
Yeah, it is pretty exciting that we're finally seeing some more communication between the two sides, right? We are now hearing from the U.S. National Security Advisor Jake Sullivan meeting with his counterpart, diplomat Yang Jiechi, in Switzerland. They talked for 6 hours, and the U.S. official talking to Bloomberg is calling them a substantive meeting, something very different in tone to what happened back in March in Alaska. And remember, those talks were not good. They were talking at each other more than with each other. Those were long monologues attacking each other. Finally, we have seen some communication between the two sides. Apparently, there could be a virtual meeting between President Xi Jinping and President Biden, which would be a follow-up to that September 9th meeting. Perhaps I'm thinking a catalyst could have been the release of Huawei CFO Meng Wanzhou recently, right? I mean, she was in house arrest for almost 3 years in Canada. She went back to China. That was sort of an opening. That was a real sore point between the two sides. But of course, there are still many technical issues to deal with, including the U.S. Trade Representative meeting with Vice Premier Liu He on how China is not really adhering to the Phase 1 trade deal.
Well, at least you're getting some dialogue. I mean, we're months into this new administration, and the fact that the leaders of the two largest economies aren't really on speaking terms is a little hard to sort of wrap my head around. What's also hard for me to wrap my head around is the Kiwi. We don't talk about the Kiwi much, but New Zealand surprised some people here with that rate hike. And
surprised only Bloomberg Economics, unfortunately. It was the only economist in a survey of 21 that thought they would hold. Wow. They did go ahead and hike.
Yeah, so they went ahead and hike, and that's putting a lot of pressure on the Kiwi.
Yeah, surprisingly, not giving it a little bit of support as we had expected. So basically, the idea is that Kiwi has been fully valued already. There's a Chinese economic slowdown that's been affecting it. You can see hedge funds have actually been selling the Kiwi. The RBNZ went ahead and hiked rates. They had held the last time around because on that day, back in August, New Zealand entered a nationwide lockdown. So they felt, okay, we can't go ahead and hike now. Yeah. But they kept giving signals that they would go ahead and do it. And they finally did it. And now the rate is at 0.5%.
Is New Zealand an emerging market?
It's an Asian economy and it's an advanced economy. I wouldn't consider it an emerging market. So I'm talking in the capacity of
that emerging action.
This is just Asia.
Just action.
Hey, Sherry, we know you're watching Korea as well. What do we think about the price pressures there and the potential for another hike?
Another economy that doesn't call itself emerging anymore. So they are now considering themselves advanced economies.
Well, we did start on China. Are they emerging? I don't know.
But it is action, right? I mean, mean, the inflation side of things, it's a lot of activity.
You just changed our whole segment.
At least
You
it's
just
action.
completely rebranded
That's the Daybreak Asia,
Developed
guys.
market
Daybreak
action.
Asia, yeah. But it's not great.
Yeah.
I mean, inflation again coming in at 2.5% from a year earlier, which is the 6th straight month that inflation has stayed above the Bank of Korea's 2% inflation target. Surprisingly resilient domestic spending, despite the fact that you're seeing another outbreak of the coronavirus in South Korea.
Sherry-Ann. She actually co-anchors Bloomberg Daybreak Asia, so she's bringing all things Asia today.
Daybreak? Oh, okay.
It's Asia action for today.
Well, if anyone wants to know, the zloty is up against the dollar right now. The rand is as well. The Thai baht down, as is the Czech koruna.
Thank you for
There's
the
your
color.
emerging action.
Action all over the shop. We thank you. Let's have a look at what the US assets are doing. I almost said a US board, but
We
that would
love
be
Sherry, by the way.
lingo. We love Sherry.
Yeah.
We love all things Asia. We love all things US
And we
right
love
now.
Bloomberg
S&P 500 up a 0.1%. Yeah, she was dissing on our own Bloomberg Economics just then about them not being the only ones that managed to miss what direction the New Zealand central bank was going to go. But did we call commodities to go down today, Shonali? Was that the thesis? Because it felt like it was the only way that was up.
Day, right? Not walking into the day, but certainly look at that drop downwards, more than 2% on the commodity index, the Bloomberg Commodity Index. Energy, the biggest loser on the S&P today.
Yeah, a lot of energy down. You are seeing some of the base metals still get a bid. And, of course, a lot of ructions right now going on in that soft commodity space. We got to talk T-shirts at some point today, folks, because this is going to have a big impact on some of our Christmas plans. This is Bloomberg.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
I'm Mark Crumpton with Bloomberg's First Word News. Senate Republican leader Mitch McConnell is offering Democrats an agreement on raising the U.S. debt ceiling through November, alleviating the immediate risk of a default. The proposal would push back the partisan confrontation over the debt ceiling, but not resolve it. It would increase the ceiling by a fixed dollar amount that could be sufficient to tie the Treasury over until December. National Institute of Allergy and Infectious Diseases Director Dr. Anthony Fauci says vaccinations are still needed to help fight COVID-19 infections, despite the reported efficacy rate of Merck's new COVID-19 pill. He spoke with Bloomberg's David Weston on balance of power.
Even if you have a pill that gives you 50% greater chance of not going to the hospital or even dying, it is always something that's common sense when you say it. It is always, always better not to get infected than to get infected and having to get.
Dr. Fauci also says he cannot predict when or if a COVID-19 vaccine for children will be approved. Canada's Prime Minister Justin Trudeau is set to announce details of a vaccine mandate for federally regulated industries before triggering early elections, which led to his staying in office. Prime Minister Trudeau announced his government would make COVID-19 vaccines mandatory for airline and rail passengers, transportation workers, and federal employees. The COVID death toll in the United States this year has surpassed the number of fatalities in 2020. The wave fueled by the Delta strain is waning, but daily infections are still near 100,000, and more than 1,800 people are dying every day on average. The U.S. has the world's highest death count at more than 704,000. That's according to data from Johns Hopkins University and Bloomberg. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
The most crucial moments in the trading day. This is Bloomberg Markets The Close with Caroline Hyde, Romaine Bostick, and Taylor Briggs.
Under 30 minutes to go until this market closes. We count them down.
Yeah, and it's stretching into the green, further into the green as we get closer to the closing bells.
Yeah, we do have most major sectors in the green, Romaine, but not everything. We have energy down more than 1% on the day. We have utilities leading the gains in the S&P. We have financials just teetering on the edge of gains and losses. Right now, you are seeing them in the red.
Hey, and you know what else is up here? A lot of the social media stocks, believe it or not, remember, they had actually taken it on the chin the last couple of days. That was largely Facebook, but a lot of the others had fallen in sympathy as well. Some concerns here, not only about the regulatory picture, but also ad spending. Twitter back higher here on the day, up about 2%. You're seeing pretty much everything in the crypto space get a bid. Bit Digital up 8.5%. Steelmakers lower here. And keep an eye on Electronic Arts here and the saga over the latest rollout of Battlefield. Apparently, some of the folks who've gotten a chance to sort of play the new game say it's still buggy. Of course, they haven't released it yet, so it's not quite clear. Then these are somewhat unconfirmed rumors, but a lot of the sell-side analysts are already out with notes saying keep an eye on this space here. This was already delayed once. Whether it gets delayed again, who knows? But shares down about 7% on the day.
Keeping us honest on the gaming outlook. Meanwhile, we've heard so many calls today about whether you should be going to value stocks at the moment, whether it's time to be buying the dip in technology after we've seen the valuations come down some. I wanted to look at what Citi's call was. Overall, they're saying, look, in this inflationary environment, in this rates environment, It's time to get into the banks. It's time to get outside of technology. And this chart shows it perfectly in terms of, well, if inflation goes higher, yields, of course, push higher because we're expecting rates to rise. Therefore, I wanted to track what's happening in terms of, well, the outperformance of banks versus tech at the same time as yields do push. How much are they in lockstep? Kudos to Dan Curtis for this one, as we see overall in the blue 10-year Treasury yield now pushing up about 1.5%. And you see in lockstep, actually banks start to outperform big tech on the S&P 500. So watch the space. Many feeling that banks are where it's at, Shonali.
Truly watch this space. But let's talk about Washington. That's affecting a lot of the movement here. We have Senator Mitch McConnell, we've been talking about it this afternoon, is offering Democrats that short-term deal to raise the debt ceiling. And that alleviates the immediate risk of default. But the news is coming as President Biden has met with the CEOs at the White House. A lot of uncertainties. Joining us now to talk about this is Charles Myers, chairman and founder of Signum Global. Charles, anytime you bring CEOs down to the White House, it creates a lot of uncertainties and some real fighting words from Jamie Dimon about what this would mean for the Treasury market the more this uncertainty goes on about the debt limit. So what do we make of today?
Well, first, I would just say that Leader McConnell's offer, if Senator Schumer accepts it, is hugely positive because it does give the Democrats another 2 months of breathing room to get the debt ceiling lifted without, hurtling headfirst over the fiscal cliff on October 18th. So the offer from Leader McConnell is very helpful. We'll see if Senator Schumer accepts it. But I would argue that it really still points to the broader dysfunction in Washington. And there's still a number of risks that I think are underappreciated in the markets. I think the markets have discounted about $2.5 trillion of fiscal spending coming between the bipartisan infrastructure bill and the reconciliation bill. Again, they couldn't get the BIF done last week. Let's see if they can do it over the next month or so. Another wild card, just quickly to leave with you, is as we continue to struggle with raising the debt ceiling, again, even if we have some breathing room, will Fitch or one of the other rating agencies take that opportunity to downgrade the U.S.? I wouldn't rule that out entirely. Yeah. Again, quite a few risks to think about in the short term.
Charles, let's talk a little bit more about that here. That took a lot of people by surprise a decade ago when that decision was made. And the reasonings and the rationale, at least as what S&P gave, that same reasoning and that same rationale seems to be out there right now in the atmosphere with regards to the dysfunction in Washington and the inability to get things done. This is kicking the can down the road for 2 months, and we're still talking about a reconciliation bill and not an actual real budget as outlined in our Constitution.
Yes, absolutely. And so, the reason S&P downgraded us in 2011 is that we actually did breach the ceiling very temporarily. And so I would argue that, given that Fitch lowered our outlook last year, the outlook on the U.S., that is usually a precursor to a downgrade. And if we cannot get the debt ceiling raised in time, whether it's October 18th or now December 3rd, I think there's a very high probability of a downgrade. I think people really are underappreciating that. The pushback we get on that is that rating agencies would never downgrade the U.S. coming out of the COVID crisis. I don't agree with that.
Yeah, what's the rationale of that? What did you don't kick someone while they're down? What would the rating agencies hold back on the back of that?
Yeah, absolutely. I think, S&P came under so much fire back in 2011 after the downgrade. And so part of the pushback is the rating agencies, again, wouldn't want to take on the U.S. government necessarily and deal with a lot of blowback. I just don't agree with that line of thinking. Also, just as a reminder, in 2011, the U.S. equity market sold off 17% over this period, over the debt ceiling and with the S&P downgrade. So it is critical that Washington resolve some of this brinkmanship and dysfunction, get the debt ceiling raised, and then they have to tackle infrastructure and a budget resolution by December 3rd. That's a lot to compress.
Charles, what kind of pressure does this put on President Biden, Secretary Yellen, and Chair Powell? Because at the end of the day, as Jamie Dimon very eloquently outlined today, this is going to cause humongous pressure when it comes to the Treasury market and even the repo markets.
Yeah, so again, I think that some of the pressure has been clearly taken off, which is why we saw this, big turnaround in the, U.S. equity market today on the McConnell offer. But the pressure is absolutely on, and pressure's on from the private sector, not only on the White House and the Democrats to get this done, but also pressure on McConnell and the Republicans to try to help out a bit. So the pressure is helpful, but, one could argue that the press conference this morning, in fact, until McConnell's offer happened, actually almost spooked markets more.
Charles Myers, thank you so much for joining us. That's the chairman and founder of Signum Global. The closing bell is up next. This is Bloomberg.
They know me as Magnus TV in Facebook since I'm streaming Axie Infinity. Axie Infinity is an NFT game where you can earn tokens, and then that tokens can be converted into pesos. I'm playing almost 4 to 5 hours a day. I'm earning, I can say it's really a lot of money. It can help to sustain my family needs and also to sustain my own business that I'm starting. I'm a little bit worried about it because some people who join this Axie Infinity thinking that this is an easy money game. They can earn a lot on this game. This game can sustain their life, and I think that is not the point, or that is not really the game. We are trying now to build a community where other players or my scholars can join this esport, playing Axie Infinity for example, even 5 years, I think.
"17 minutes until this market closes, and we actually managed to push into the green. A wealth of news coming, whether it be perhaps more progressive talks when it comes to China and the US, and a virtual meeting on the cards between President Biden and Xi Jinping. There's also, of course, the news of the debt ceiling. Do we see some sort of pushing the can down the road until December at least? We breathe a slight sigh of relief, up 0.1%, but also commodities helping the market a little bit. Bloomberg Commodity Index coming down, gas prices coming down. Putin to the rescue there. Therefore, inflation worries, do they come down a bit? The break-even drops. Meanwhile, Bitcoin up to 54,000 as we speak. Lizanne Saunders, Chief Investment Strategist, is here as we run towards the market's close. She's a cause of Charles Schwab. And Lizanne, what do you make of, well, the topsy-turvy nature of this market at the moment? The worries seem to be really a wall of them right now. Are we continuing to see volatility into the future?
I think so. And I think the nature of some of the volatility, even before we saw this most recent version of volatility in the past month or so, has been associated with these rotational corrections, these really swift leadership changes that have occurred under the surface, whether it's at the sector level or at the style index level. And with each of these turns and rotations, I think the proximate reason has varied. It's sometimes been the move in the 10-year yield. It's been driven by the Delta variant and the incidence of cases. At times, it's a function of the inflation data or weakening economic growth expectations, policy uncertainty. And it's hard to think that we exit this type of environment anytime soon.
And it seems to have sort of all come at a time when we're already, I guess, at the proverbial inflection point. A lot of people trying to decide whether the rebound in the economy was real. A lot of people trying to decide whether whatever changes might happen in monetary policy, whether that would disrupt some of the gains that we've made.
Oh, no question about it. And I think, obviously, not that I think we're establishing a 70s style stagflation environment, but if you think of stagflation with a lowercase s and just talk about any time, regardless of however stunted a duration, where you have descending growth expectations in the midst of rising inflation, that dynamic kicks in, the narrative kicks in. And there's no question that's what we've been seeing, because we're not yet seeing an easing in inflation pressures. At the same time, using GDP Now from Atlanta Fed, we've gone from 6.2% back in July to now 1.3%. And that's a pretty significant deceleration in the last few months.
All right, we're in conversations right now with Liz Ann Saunders, Chief Investment Strategist for Charles Schwab. She's sticking with us as we count you down to the closing bells. A little less than 15 minutes to go here in the trading day. We started out deep in the red here for all the major indices. S&P 500 right now in the green. The Russell's still a laggard there, but well off the lows of the day.
Yeah, well off the lows of the day. And meanwhile, we are seeing still yields flat, but still at an elevated level, 1.52%. But are we sort of more worried about inflation? Or are we less worried about inflation? And we start to see gas prices come down, Shonali?
Yeah, Bitcoin's still teetering higher, guys.
Is it an inflation hedge?
Who knows?
It's a store of value. No, it's transactional. I don't know. We'll discuss it when we come back. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Extremely thankful. They don't know what to say. Again, they can't even fathom that they're out of Afghanistan. They're still in a state of shock and can't believe it.
What we have built through this process is essentially a mechanism for getting oppressed women and girls out of Afghanistan. So we're actually going to circle up and see what resources we have left, to see what options we have left, what mechanisms we have left, and actually look at potentially trying to get more women and girls out of the country as well.
through a lot, us as a team. I know sleepless nights, but you know what? There's nothing more satisfying than knowing that you've saved many lives, and will continue to support these girls on their missions.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We have a surge in demand. As you know, we had a lot of fiscal support, and that's, we've passed the peak, and that means it will also fade away.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Countdown to the Close, and Caroline Hyde.
I'm Romaine Bostick.
And I'm Shonali Bassick. Taylor Riggs is off today.
Meanwhile, we want to check in on what's happening in terms of the S&P 500 and in terms of, the trading range, which basically is falling in line with where we were on Friday. Such a torrid day was on Friday, the lows that moved into the highs towards the end of trade. We've basically stuck to that. It's felt like volatility for sure. We've had, 4 days now, straight days of in excess of 1 percentage point moves. But we do seem to be within a certain trading band, Romaine.
Yeah, within a certain trading bound, and I think this is a market sort of looking for direction here. You look at some of the individual indexes here. You can see financials, which were much lower here on the day, managing to rebound. Oil and gas stocks lower here on the day, as are the steel companies. And once again, I'll talk about some of those social media companies that have been beaten up. A modest bid coming back in, at least collectively here, up about 0.4%. Still with us, Liz Ann Saunders, Chief Investment Strategist over at Charles Schwab, helping us count down to the closing bell here. And Liz Ann, I am curious here about sentiment here. We've seen before drawdowns, maybe not as big as the one that we got over the last couple of weeks, but we've seen some significant drawdowns this year, and we've seen the dip buyers come in or at least rotate into maybe other pockets of the market. It didn't appear that there was a lot of cash coming out of the market, but we've heard from a lot of folks over the last few days basically saying that, hey, now would be a great time to take some money off the table.
So I think that you're right. We've not seen a significant change in terms of cash positions. There's been a lot of churn. And what I think has happened more recently in terms of at least the cohort of retail traders, some of the newer entrants into the market over the past year and a half or so, there has been a market shift in their attention away from some of the highly speculative areas, whether it was, meme stocks, heavily shorted stocks, SPACs. You could even put crypto on the list. You can look at other sort of lower quality areas, bankruptcy stocks. And that really came to fruition in terms of that cohort's maximum drawdowns in the sort of February to May period of time, where across the spectrum of many of those areas, you were talking about drawdowns of at a minimum 30%, in some cases, in terms of the meme stocks, 70 or 80%. And then more recently, you saw a shift into some of the more traditional averages, into some of the FANG stocks. And there hasn't been enough pain yet, probably, to have that cohort now be looking for the next shiny object. But it is going to be interesting, since their attention is no longer just in these non-traditional segments of the market.
Now that takes care of the day traders, right? The retail traders. But the big institutional investors, we've heard over and over the last 24 hours, this idea of a correction. And I'm wondering what that means to you in terms of kind of what you wait for to get past to really start buying into this dip in a real, more significant way.
Well, we've had, plenty of correction even within a benchmark index like the S&P. Through yesterday's close, 91% of the S&P's constituents had at some point this year at least a 10% drawdown from highs, with the average being negative 17%. By the way, in the NASDAQ, it was 90% of stocks, with the average drawdown being 38%.
Wow.
So pretty deep bear market territory. But that's the nature of rotations, where there's been significant weakness. That weakness has spread around various segments, and at times where there's the greatest amount of weakness, there's offsetting strength. That has kept the overall indexes afloat. To see an environment where at some point the index level catches down and goes into correction, it wouldn't surprise me at all. But a lot of that correction has already happened under the surface. So it's been a correction via rotation without the index itself reflecting that, at least not yet.
Lizanne, you were talking at the very start about how this has been rotations under the surface and they happen very swiftly. It feels as though now more and more are saying it's time for value. It's time to get into banks, for example, to offset inflation risk and offset interest rate increase risk. Do you buy that in the longer term, that what can take us higher? Because without big tech,
I buy that you want to look for value now. But shame on anybody that doesn't go at least one layer further and explain what you're talking about when you're talking about value. Because even if you're talking, say, as a passive investor about the value indexes, look at the difference between what's in the S&P value index or the Russell 1000 value index or the Russell 2000 value index. If you have a positive financial story, then you have a positive Russell 2000 value story because it's about 28% of the index, but it's a lot less in those others. You can look for value outside of areas that live in the value indexes. Another kind of reverse example is utilities. Utilities are really expensive right now. In aggregate, they have a higher PE than the S&P. They're not value stocks, regardless of the fact that they live in the value indexes. So I think you want to take a value approach, but have it be a hybrid approach. Look for value characteristics. Don't give up the growth. Have an overarching overlay of quality. And apply it regardless of whether you're looking in financials or you're looking in tech or you're looking in healthcare. And that has been the most consistent outperformer even throughout this rapid fire rotation. So I think investors should take a factor approach more so than some predetermined style index approach or even sector approach.
I do want to get a quick question in here, Lizanne, about some of the moves that we've seen in the commodity space here. We've been talking a lot about energy, but we're now starting to see a lot of price pressures when it comes to the soft commodities, including cotton. We're heading into an earnings season where a lot of people are looking for some commentary about some of these price pressures and whether companies are able to either absorb those costs or pass them along here. Are you worried at all about what we might hear out of some of these companies over the next few weeks?
So I am, first of all, I'm very worried about what's going on with energy, and not so much just tied to the stocks or sectors, but some of the serious problems that are starting to creep up, whether it's in UK with natural gas and the connection there to Russian supplies, whether it's what's going on in China and the need to have kind of, forced rationing of electricity, and Brazil and India and the feeder effects. And I think there's not as much attention on that whole broader macro topic as there should be. In terms of the answer specifically to your question about companies, I think the margin story is at least as important to listen to in third quarter reporting season than just what the beat rate is for the quarter. To see whether companies have that ability to pass on these higher input costs, and in turn what the pressure might be on what have been still very robust profit margins. That story may be changing.
How is it almost earnings season once again? Lizanne Saunders, this year flies by, Chief Investment Strategist at Charles Schwab. Always great to get her voice on the show. Meanwhile, guys, we look ahead to earnings, we look ahead to margin pressure, but we look ahead to a market that remains higher at the moment.
Yeah, still higher and still holding on to some of these gains. You wonder if we do manage to climb out of the hole here. Keep in mind, you're still talking about indices that are still down significantly here from their most recent highs here. We're going to talk you through here what's happening on the day right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick, Caroline Hyde, Shanali Bassick in for Taylor Riggs, counting you down to the closing bell, here to help take us beyond the bell. It's our global simulcast. Carol Massar and Tim Stenovic bringing together all of our audience across television, radio, and YouTube here. And right now, Carol, we're looking at an S&P 500 that was significantly lower on the day, and now I guess you can call it significantly higher. What do you make of this?
Yeah,
and keep it clean.
All right, kids. I'm going to try and use my words very carefully here. It's been a two-part day. We saw selling in the beginning half of the day. We saw buying after that news out of D.C. But what's interesting is, we're still below our 50-day moving average. The technicians have to be watching this. And our Abigail Doolittle, earlier saying that trend line, that 50-day continues to move lower. So when it comes to dip buying, we're seeing less buyers come into the market, Tim.
Hey, how about Bitcoin surpassing $55,000 higher by close to 7% on the day, Caroline? We did get a little bit of the worry of the concern from Washington, D.C., a little bit of that alleviated, but I'm still thinking about inflation. I did speak to Gina Martin-Adams at Bloomberg Intelligence for the Bloomberg Invest Conference. I know you guys had a lot of that on today's show, and she said investors need to take seriously inflation, the idea that it's stickier than policymakers are saying, and that could start to hit margins, and we could see that in earnings reports coming out in the next few weeks.
But I wonder if almost today inflation risks came off the boil a little bit as those extraordinary moves in gas prices, extraordinary moves across the commodity spectrum just dialed down a little bit. I mean, who would have thought it would be Putin to the rescue there?
Yeah, Putin to the rescue, and JP Morgan with the $130 oil saying it's all right if that's okay.
43.19. That was your open on the S&P 500. Your low of the day was 42.90. Right now, we're sitting right around 43.63, which is right around the highs of the day. That's up by about 0.4%, 18 points on the S&P 500. Dow Jones Industrial Average up about 0.3% or 100 points. The Nasdaq Composite going to finish the day up right around 68 points or about 0.5% here. Interesting move, though, in the Russell 2000 here. You're talking about a day here where you talk about buying the dip. People weren't necessarily buying the dip when it came to cyclicals. The Russell 2000 actually opened only down about 0.1%. It got down to about 2%. It's going to finish the day down by about 0.6%. That's a lot of 0.1% there, but what it tells you there, Carol, is that a lot of folks here aren't necessarily gravitating back to some of those cyclical trades.
Don't you find it interesting on a day where the S&P 500 erases that 1.3% loss, biggest reversal since February, and you have the VIX actually dipping back a little bit? This was a fair amount of volatility, and that I feel like when it comes to the markets, there's a lot of questions out there, but that's one thing I feel like we can be pretty consistent about. There's a lot of volatility in this market.
And heavy trading as well amid that volatility. What was interesting, if you look from an industry perspective, that all of the winners yesterday became kind of the losers today. We see energy, your underperformer, off by 1.25%. We were talking about it, how gas prices screeched back down. Oil came off the boil a little bit as President Putin seemed to say, look, I could be there to rescue energy in terms of the gas from Russia into Europe and prevent that crunch over there. We're seeing energy off. We're seeing the likes of materials on the downside, auto companies as well on the downside, semiconductor equipment. That had actually been outperforming yesterday. They're on the lower side. But on the upside, actually your bond proxies, there's a good Taylor Riggs kind of a line. Utilities up more than a percentage point. We're seeing also real estate do relatively well. Why? Well, yields actually crept down that little bit today.
Yeah, and I'm thinking about what you said about Putin to the rescue. We are living in unusual times. All right, let's get to some of the gainers. NetEase topped that list up 6.6% here, 88 and change. Jeffrey's out saying the Chinese video gaming company shares could gain in the fourth quarter on the possible release of Tencent's League of Legends Wild Rift, and expectations that China could begin approving new games in November after holding off on approval since August. They also estimate, and this has to go to the China banning of gaming, Jeffrey's estimates that just 15 to 20% of China's gamers are minors, so most users will not be hit by the new rules. All right, let's talk about ICE, Intercontinental Exchange, up 3.8% in today's session. Top in the S&P 500, Raymond James coming out and boosting its price target on the stock to a street high of $144 a share from $140, so a little bit of an adjustment, maintaining its strong buy rating on the company. And PayPal, up today. If you're on a United Airlines flight, check this out, everybody. PayPal, you now can use PayPal and its PayPal QR codes in the PayPal app.
PayPal
so you can make
online on airplane.
You can make touch-free in-flight purchases.
Why would I want to do that?
I don't know. I know. What do you? I got to tell you, I want a nice glass of wine. I want to read something.
I do not want Wi-Fi.
I agree with you, Caroline.
Yeah.
It's like one of the last places you don't get inundated with texts and phone calls, right? The
Leave me alone.
Leave me alone. Well, I'm gonna go to some decliners. I'm not leaving those decliners alone. Let's talk about Moderna. Shares finishing the day down, while close to 9% on the day. This comes after Sweden and Denmark earlier today said that they would halt Moderna shots for young people over potential side effects. Denmark is going to stop giving it to people under the age of 18. Sweden will stop giving it to people under the age of 30. The concern is increased risk for side effects such as heart inflammation, myocarditis, pericarditis. They also said, though, Sweden in particular, that the risk for such side effects is, quote, very small. Airlines under pressure today, thanks to a note from Goldman Sachs. American Airlines shares finishing the day down by more than 4.3%. JetBlue finished the day down by more than 2.6%. Goldman Sachs downgraded American to sell from neutral, downgraded JetBlue to neutral from buy. Goldman sees 2022 as a recovery year for the airline industry, but does expect the industry to go back to those 2019 levels, Caroline, to see margins recover to 2019 levels in 2023 and then improve in 2024 and in 2025.
Interesting set of down day in terms of the individual stocks. What's also down is most FX versus the US dollar today. I'm trying to struggle for a narrative here because in the market in the stock market, we felt a little bit more optimistic about the debt ceiling, whether it be about, of course, relations between US and China, whether the ADP employment report came in better than expected. But in FX, it seems to be the narrative that actually we're a bit risk averse. We're coming out of most things and going into the US dollar. We're perhaps Japanese yen, the second best performer in that respect. So the euro's off by 0.3%. We've been talking a lot about the Kiwi with Sherry-Ann, of course, off by 0.7% as the central bank seems to be moving there, unexpected by Bloomberg Economics. Meanwhile, overall red on FX, red on commodities. And this is perhaps also a story of in the metal spectrum, people worrying about growth, whether or not we'll see inflationary pressures and overall growth be stymied. And that meant that metals fell, copper down. We also, though, saw a significant plunge in natural gas. That as we hear President Putin saying, look, maybe I could ease that gas crunch over in Europe. We see also WTI crude come off as we worry less about supply chain issues there, worry less about the supply concerns. WTI crude off by 2.5%. All of this muddies the picture for me. But overall, I'm looking at, well, money moving into Canadian bonds to a certain extent, into the UK for once. Remember, they've been selling off significantly in the UK on the back of the gas increase in prices, inflation concerns.
Yeah, and you talk about yields back here in the U.S. Did see some activity on the short end of the curve, as well as in that belly here, particularly around the 7-year here. But relatively where we stand right now for the last couple of days here, 152 on your 10 and still holding above 2% here on the 30-year yield. Your 10-year break even still camped out right around 244 basis points here. And this really brings us to the broader question here about whether you start to protect yourself against higher rates and against inflation. There was a great note out, guys, by Citigroup's global equity strategist, Robert Buckland, talking about this issue and how investors in the equity market should protect themselves against rising rates, actually saying that value stocks might actually be where you want to gravitate to, not necessarily for the return, but I guess because it'll be less bad than growth.
Yeah, exactly. Less bad than growth. And if you take a look at the best performers, the major industry groups in the S&P 500, there are 11 of them. The second best performing group is financials. They're up about 31%. So we have seen that investor movement this year. And some of it has to do with the improving rate curve and the prospects and what that means certainly for banks in terms of making money. But yeah, you're seeing kind of movement, Tim, certainly within the market.
Yeah, I did find that note I did find that note from Citi really interesting because, as you mentioned, Carol, when we see that movement in rates and we do think that those rates are going to move higher, then certainly banks do well. But then again, the growth stocks don't do as well. Even the high-flying tech stocks that could potentially have their cash flows discounted more with those higher rates, and that's why we've seen this sell-off in tech in recent days.
And then of course, you had out the commentary by Mike Wilson, of course, over at Morgan Stanley, who, of course, has been right on so many things here, and he talks about the volatility out there and really kind of how you sort of protect yourself heading into this earnings season, this idea, and he's really been really good about this, Caroline, this idea of sort of where we are in the economic cycle, and based on where you think we are, that's going to dictate how you invest.
And so many of those conversations happening at the Bloomberg Global Invest Summit. I was speaking to John Rogers, of course, legendary value investor, who unsurprisingly thinks this is a good time to be getting into value, but not calling out the banks, calling out instead some of the opportunities in sports-related companies, in Madison Square Gardens and the like. We're also speaking, though, Bridgewater Associates co-CIO Greg Jensen, he was over at the Invest Global Summit. He was talking about inflation risks, about interest rate risks. Take a listen.
The problem is stagflation. That's the real risk. And so many portfolios are massively exposed. And there are ways to hedge that risk, to try to arbitrage that difference between the likely nominal outcomes and those available in financial assets today.
And I know there were so many important conversations going on. Shonali, you were talking private equity, of course.
Yeah, absolutely. And a lot of concerns, right, about decelerating growth as people shift towards those value names.
The dreaded S word, stagflation. All right, that's going to do it for our cross-platform coverage Beyond the Bell on Bloomberg Radio, Bloomberg TV, and YouTube. Catch us again, same time, same place, tomorrow.
More markets coverage coming up right here on Bloomberg TV as well. We're going to be talking with Elizabeth Crane, founding partner and CEO of Moelis. I think she's COO, in fact, talking about perhaps all the opportunities in the market, but also we're going to be speaking about some of the supply chain issues. And Dow Chairman and CEO Jim Fittling's with us to talk all that as they have their Investor Day. This is Bloomberg. Dealing with that blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours, and renewables. We have a very strong climate component in our government and in our government programme, and that, of course, is not disconnected from the energy agenda. And there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data?
Data is taking up considerable demand in energy terms, but we have been robust in terms of meeting that to date.
The August jobs report packed a big downside punch.
That is a really, really dismal number.
Will September bring enough good news for the Fed to start a taper?
If progress continues broadly as expected, a moderation in the pace of asset purchases may soon be warranted.
Will unemployment keep going down? And what's happening with wage inflation?
It might be a little bit more sticky than maybe Jerome Powell and some of the Fed members think.
Tune in for the September jobs report, Friday on Bloomberg Television and Radio.
Quite the wild ride this Wednesday as we see the market dip some, off by more than a percentage point. We rally back up 0.4%. I think this is the biggest reversal that we've seen all the way back to February in terms of your indices. S&P 500 manages to push higher as we get a raft of sort of positive news, whether it's about the debt ceiling that can be kicked down to at least December. Maybe that'll work out from a US perspective. We also get, of course, maybe Putin helping out the energy crisis. And notably, we look at China and the US relations perhaps improving there. NASDAQ up 0.5%. But what didn't catch a bid was the Russell 2000. Energy was on the downside. So too was the banks. Interestingly, that technology did get a little bit of a bid today. This after valuations have come crashing back down on some measures. If you're looking at basically the forward-looking PE ratios for the FANG index, we're actually seeing it looking pretty much the most cheap that we've seen since all the way back to 2018 versus the S&P 500. So we're starting to see that premium come down some and significantly look a little bit more of an opportunity to buy. But remember, big tech is being sold up, growth stocks being sold off because we're worried about inflation, we're worried about interest rates. We're worried about inflation because, of course, what's been happening with commodities. But today, we breathe a little bit of a sigh of relief. Natural gas comes crashing down 9 percentage points. But remember, it's been on the up and up, significant moves to the tune of 60%, certain measurements in Europe. Now, finally, President Putin seems to say that, well, with some strings attached, maybe he could help in terms of the supply crunch over in Europe as we head towards the winter. We breathe a sigh of relief. Natural gas comes down, so too does oil remain.
All right, let's get back to the other parts of the market here and talk about some of the volatility that we've seen. We talked about that drawdown, of course, that we saw last week and how it actually scuttled that more than $14 billion deal between Zoom and Five9. Attention now being raised on the potential ripple effects for other deals. There's been $4.1 trillion in global M&A deals announced this year. To discuss this and a whole host of other topics, we're really pleased to have with us right now, sitting right next to us, Elizabeth Kane. Of course, she is the COO and founding partner over at Moelis & Company. Elizabeth, great to see you.
Great to see you. Thank you for having me on today.
Absolutely. Let's start off with the volatility and how that affects, if at all, the short-term volatility affects the deal environment, particularly the deals that are in the pipeline.
No, we're not seeing the momentum slow down in any way. The fundamental factors that have been driving M&A for the last 12 months continue, and I think an important factor that we find particularly interesting is the role that alternative asset managers are playing in this environment. The funds flowing into alternative asset managers are the highest levels we've ever seen. We think that is going to continue to accelerate, and they're becoming a real force, perhaps a dominant force in the M&A market. And driving both the scale of the market, the velocity of transactions, and what we believe is a continuation of this M&A environment. If anything, we think it is more of a secular growth in M&A as opposed to a secular M&A cycle.
So companies need to also sell things when they're alternative asset managers as well as buy things, but there's so much volatility in the market, and I'm wondering what that means for the upcoming IPO pipeline, capital raising pipeline. Are you hearing any uncertainties among investors when it comes to capital markets?
You know, it's an interesting question. I think when you look at the number of IPOs that have been done year to date, it's an extraordinary number. And historically, when there's a lot of equity market volatility, you would expect to see some interruptions to the IPO market, and we may expect to see that in the fourth quarter. But what is interesting is all of the private capital that is available for those pre-IPO rounds, for that growth equity investment, for crossover investing. For a company that's contemplating an IPO, and accessing the public market, if that's not available in the near term, there's capital that's available to help them fund and deliver on their business plans.
Okay, so they can look to various routes to be able to put money to work. Whether or not they ever invest in the business, we don't know, or whether they give it back to the investor. But I'm interested in geographically your perspective. We're talking a lot about US valuations, talking a lot about the US IPO pipeline. What about elsewhere in the world? Have we seen more questions about volatility, more questions about coming to the market or not?
No, we're not seeing that from an M&A standpoint, certainly. I think if anything, we are seeing strategic buyers as well as financial buyers very much focused on Europe. The M&A environment in Europe is probably as robust as we've seen in 5 years, with transaction volumes up and valuation, in part because of valuation differentials that I think you have seen historically between these two markets.
So, Elizabeth, you know, you're back in our office today, and you're having bankers back at your offices and flying around the world still. Do you know, how do they feel about spending more time in the office now?
I think at the core, we all realize that we are better when we come together, that we're more innovative, that we are creative, that we, at Moelis, it feeds solutions for our clients. And at the same time, I think it's important for us and for every employer to acknowledge sort of the best, to take the best of what we've learned over the last 18 months, to provide a degree of flexibility, whether that's in a given day or over the course of a week, so employees can balance their lives and continue to, in our business, deliver to our clients in an exceptional way.
Here's the balance. Elizabeth Crane, Moelis Company. Thanks for coming in.
Thank you. Pleasure to see you today.
Meanwhile, let's get some first word news. Here's Mark Crumpton.
Caroline, thank you very much. Senate Republican leader Mitch McConnell is offering Democrats an agreement on raising the U.S. debt ceiling through November. That would alleviate the immediate risk of a default. The proposal would push back the partisan confrontation over the debt ceiling, but not resolve it. It would increase the ceiling by a fixed dollar amount that would be sufficient to tie the Treasury over until December. 2 scientists won the Nobel Prize for Chemistry today for a finding that the prize committee called an ingenious and environmentally cleaner way to build molecules that can be used to make a variety of compounds, including medicines and pesticides.
What Professor David McMillan and I have discovered in around the late 90s was that there is a third class of catalysts available with which we can make all these molecules that we need, like drugs and scent molecules, but also plastics, pretty much everything that surrounds us. And the new class that we discovered are organic molecules.
Over the coming days, prizes will also be awarded for outstanding work in the fields of literature, peace, and economics. Ares Management, one of the dominant players in private credit, is now underwriting deals as large as $3 billion and could soon provide loans for as much as $5 billion to a single borrower. That's according to their CEO, who spoke at the Bloomberg Invest Global Summit.
I think you will see more firms coming public. I think many of those firms will be single asset or asset specialists, and
like
things
Peters
like
Hill?
Peters Hill, or in real estate or in infra. As that universe of public entities comes, the valuation discovery becomes easier, and I do think you'll start to see alt consolidation as well.
And the executive says there are circumstances where private markets, even though they're more expensive, offer a better value proposition to sponsors. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Essa população é uma população importante, é uma população que frequenta a escola também, né? Então é importante que eles também estejam protegidos para o coronavírus, evitando assim a transmissão.
Eu estava esperando muito por essa vacina. Desde o ano passado eu estava torcendo logo para poder minha vida logo voltar ao normal, que eu quero logo voltar para a escola, eu quero voltar a sair com meus amigos, eu quero sair, eu quero voltar à minha vida normal. A dose foi toda administrada.
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
you
drop
great.
The bow tie. Drop the bow tie.
What, skinny tie?
Yeah. I always say, this is my line, whenever anyone in America has to go at me about a skinny tie, the older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
Is Dow's Investor Day. And joining us live from the NYSE is Jim Fitterling, Chairman and CEO of Dow. When you had people in person, 60 investors that you could see in the flesh, most still virtual to a certain extent, Jim, but plenty to be outlining. You're talking about additional EBITDA growth in the tune of in excess of $3 billion. You're looking at decarbonisation, particularly of your assets. But talk to us first and foremost, before we get into some extraordinary moves in the commodity sector that you're exposed to, talk to us about how you get to that level of additional EBITDA growth in this realm.
Yeah, what we unpacked today, Caroline, was an investment plan over this next decade that will help us get some efficiencies and digitalization improvements in our industry, in our business, which will bring about $600 million of that EBITDA growth. A lot of investments in all of our downstream businesses, really driven by a circular and sustainable economy, demand in every market that we serve, packaging, infrastructure, mobility, and consumer. And those will yield about $2 billion of earnings growth over the period from now to 2025. And then a big investment in Alberta, which in the 2027 to 29 timeframe will build the world's first zero carbon emissions ethylene facility
in Alberta based on using recycled off gas from the crackers into a clean circular hydrogen production, which will fuel the furnaces on that site. That'll be the world's first and largest zero carbon ethylene production facility, and we'll make plastics at that facility.
You've been urging US to follow Canada, basically, as well, in offering larger incentives to companies such as yourself to reduce carbon emissions. Do you hear that from the administration? Do you think that we will see greater incentives? Would you act on it if you did?
Well, what I highlighted today was Canada has a really good program, and Alberta has been fantastic to work with, both in terms of fast-tracking the permits, but also the availability of the Alberta Carbon Trunk Line, which is where the CO2 that's captured from our investment will go. They have a market price on carbon, which is $45 a ton today, projected to go to over $100 a ton in the near future. And they have incentives that support the investment in low carbon emitting technologies. I believe that the United States is poised to do this, and we're advocating very strongly for that. And I think a market-based price approach for carbon and incentives for low carbon emitting technologies is the right way to go.
Do you think we're going to get there in the U.S., Jim? And I'm also curious as to the transition effects.
I think we've got a mic problem. Sorry, Romain. We're talking about your transition at the moment, in particular 8 new renewable power packs reducing emissions. It's interesting at the moment we see gas prices spiking, we see people worried about energy costs because in some ways OPEC Plus is blaming the energy transition, renewables coming in too quickly without the support. Do you believe that that is an issue, the transition?
Well, I think two things. One, we have to have an all-of-the-above energy policy to be competitive. Renewables are coming in fast, and that's very good. We use a lot of renewables, and we supply a lot of materials into that space. We announced partnerships today, more, that will take us to above 850 megawatts of renewable power usage. But the sheer quantity of energy that we need is not going to be supplied by renewables. What's happening now, and it typically happens in the winter as you move into wintertime and inventories are low, there's a run for available power. And you've seen it with coal in China, and we've seen it with natural gas in Europe. When inventories are low and you think there's going to be a cold winter, these prices can run up. You need abundant, reliable energy year-round, and natural gas is that base load today. And if you want to decarbonize, you need natural gas so you can replace coal, and we're going to need new nuclear. So this is not an unusual situation, and I think it will be short-lived, but it can certainly spike prices up in a hurry.
Well, Jim, how are those price increases impacting you, and how do you expect them to be impacting you in the next couple of months?
If you look at Europe and if you look at Asia, most of our feedstock and energy there comes from petroleum and naphtha. So oil prices are about $80 a barrel today, so they haven't spiked like you've seen with coal and with natural gas. So we won't crack natural gas or use as much natural gas in Europe. We're advantaged in the Americas, so Canada, the United States Gulf Coast, Argentina, our plants in Saudi Arabia and Kuwait are all advantaged, so they'll weather the natural gas situation well because they've got a competitive advantage. And that was a big part of our investment in Canada, structural cost advantage that can be locked in for both energy and feedstocks for our assets.
Diversification is where it's at, and you continue to do it and aim to grow, as I say, EBITDA growth by more than $3 billion. Jim Fidling, great to have some time with you. Thank you very much indeed, Chairman and CEO of Dow, live from the stock exchange floor. And that does it from Bloomberg Markets The Close coverage. Stay tuned. What you missed, we've not cancelled Romain now. He's back on, and he's got his mic. And we'll be talking about, well, some of the key conversations you've had at the conference today.
Yeah, I mean, we had a great day here, a second day of the Bloomberg Invest Global Conference. I actually spoke with Gene Hines over at Wellington, David Hunt over at PGIM. I know you spoke with John Rogers at Ariel, right?
Yeah, a bit about value investing, not so hot on the crypto space. What about the private equity front, Shonali?
Yeah, absolutely. Q-Sung Lee at Carlisle also sees some opportunity for growth, so we're not canceling it all out.
All right, we're going to bring you highlights from all that and give you a little bit more analysis about what went down. You know, look, if you missed the conference, this is your chance to finally catch up. Shame on you.
Shame on you. But we've always got the best bits.
Got your back.
This is Bloomberg.
So the 1972 Madison Square Garden eyelet jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones, really, for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses, because we have a captive audience. We have people home that really want something to do and need entertainment, so we do our best to try to give it to them.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think that at $80 per barrel, maybe some of them will be less cautious, will restart somewhere else, and then you could see again. But all that is a little delay. So we have entered into, I would say, a cycle of high prices.
From Bloomberg's World Headquarters in New York, I'm Caroline Hyde.
I'm Romaine Bostick.
And I'm Shonali Bassick, in for Taylor Riggs today.
And this week, well, Bloomberg has brought together some of the biggest names in finance at the Bloomberg Invest Global Conference. Now, our conversations focusing on key issues driving investment strategies, discussing how smart money, dare I call it smart money, institutional money, can safely navigate an uncertain and risky environment. Now, over the next 30 minutes, we dissect the key themes we heard from our guests. First, when we start with Ariel Investments Chairman and Co-CEO John Rogers, we're going to be hearing about that well-known investor telling me where he's finding value right now. Of course, he's indeed a key investor in the value chain, but you've been talking about asset management, Romaine.
Yeah, I mean, we had a great discussion. David Hunt is just a legend over there at PGIM. Jean Hines, who anyone who wants a career in finance, just look at what she did. And Julian Salisbury over at Goldman Sachs. They all talked about a wide variety of things, but it was interesting. They made some interesting comments here about SPACs and whether kind of the wrapper of SPACs, whether there's some legitimacy to that in the long run. Take a listen.
We're not offering SPAC vehicles to our clients, but we're investing in SPACs if they represent good value. And I would say that's, again, based on the research. Do you believe in the owners? Do you believe in the people who are raising the money, that they will be good allocators of capital? So in some ways, it seems like there was a boon of SPACs. Maybe that will take a breather, but as a vehicle, it's likely to be a vehicle that will be around for a long time.
What we've seen in SPACs is just how difficult it is for companies to go public. And companies, as Jean pointed out, are more and more choosing to stay private. And I don't necessarily think that is a good thing. Partly until we get to democratization of alternatives, that means that excess return is being captured by institutions. So at the moment, it's very clear that the public market IPO process is not as efficient or as easy as people need it to be.
The SPAC product or SPAC wrapper is a perfectly fine solution for companies. I think it was a solution that was overly exploited in the early part of this year, where there was just too much euphoria around it. I think it's a useful solution for a seller of an asset, not only because they're able to get to the public markets, but often able to achieve greater secondary liquidity than is possible through a traditional listing. I think it's a useful solution. It's a useful product to have in the market that was just used, too ferociously in the early parts of this year. I think just given some of the economics around those wrappers, and that will no doubt lead to some companies going public that weren't yet ready to go public. There'll likely be some disappointments over the next few months, and I think a kind of pause here and a period of consolidation in the raising of these SPACs, I think, will be healthy for the overall market.
All right, Julian Salisbury there, of course, global head over at Goldman Sachs Asset Management, David Hunt over at PGIM, and Jean Hines over at Wellington Management. That was part of the Bloomberg Invest Global Summit that we had earlier today. They were talking about a wide range of things. One thing we didn't touch on, though, Caroline, was some of the issues surrounding inflation and the whole growth value debate.
Yeah, growth value was exactly where my conversation with John Rogers went, of course, of Ariel Investments. Amazing man. I mean, set up Ariel Investments in the age of 24, has then gone on to, of course, lead one of the longest-serving funds in the small and mid-cap space that has outperformed over that 35 years.
Yeah, that's one thing about talking to these people. They make you feel very small.
Exactly. Was trading in stocks as a kid and then was really a growth man until he found, well, the contrarian view won him over. He really went into value. And at the moment, this is the time to talk value, right? We're just hearing Citi's call, talking about getting into banks to try and overcome the inflation risk. Take a listen to what he said.
I think that the S&P 500 that is so dominated by large growth stocks is very, very expensive on a historic basis. So I'm not surprised to see this most recent retreat and correction that we've been going through. But the small and mid-cap value sector is still, I think, significantly undervalued. There's a lot of bargains out there, a lot of orphans that have been kind of left for dead that no one cares about. So it really is a tale of two markets. The large growth stocks are expensive, but the small, mid-sized, undervalued securities are real opportunities there.
Just give us, first and foremost, your distinction of what a value stock is right now.
We've been very, very influenced by the world's greatest investor, Warren Buffett. We're always looking for the stocks that are statistically cheap, selling at low price to EBITDA multiples, low price earnings multiples on a historic basis. And ultimately, in the end of the day, we want to find companies that are at least selling at a 40% discount to the private market value.
I like it that he was talking about these orphans left for dead. He then said a good opportunity is Manchester United, which I'm sure many a Brit wouldn't like to hear, that they think that that's some sort of orphan left for dead. But he was talking about a lot of these sports opportunities in live events, Madison Square Gardens and the like. Some interesting stock picks that he had, Shonani.
It's so interesting, your conversation. He hated some of the retail picks, like crypto. He wasn't so into it, sounded like. But memes, right? But sports actually is a huge retail pick, as we've been talking about a little on throughout the week in the sidelines. You know, that idea of value leads me to talk about valuations, right? Carlyle CEO Kyu-Sung Lee said he's not too worried about a little inflation, but is concerned about the impact on rates and valuations. Take a listen.
A little bit of inflation is not the worst thing in the world, and we are very focused in on it. But I'm much more worried about the impact on interest rates and valuation multiples. Certainly, asset prices are incredibly high. You're seeing that driven for a whole bunch of different factors, one of which is very, 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 very low interest rates. And to the extent that transitory price pressures become a little bit less transitory and gets built into inflation expectations, and to the extent that through policy or other things you see rates start to back up or valuation multiples start to come down, you could see corrections. Certainly China has already gone through a bit of a correction. We may be seeing a little bit of that right now. Who knows? But look, we're in the long-term business.
Then do you think that right now is a good time to be selling assets given where valuations are?
We see enormous opportunity, and we're putting more money to work and investing in regions and in industries that we find incredibly attractive. So again, the benefit of our platform, we're always selling, we're always buying, but make no doubt about it, when valuations are high, to the extent that we can in our portfolio, we'll take advantage of it.
Yeah, it's really interesting. We know separately that Carlyle is actually in the process of what can be the world's largest private equity fundraising. So they are certainly getting ready to put more money to work. So
they're buying the dip.
They are certainly ready to buy the dip.
The interesting thing, though, speaking with all these people and hearing all these, I mean, a lot of them talked about this idea of, taking risk in an era where, you have an economy that may, I hate to use the S word that you use, Caroline, stagflation, but you could be headed for a more reasonable economic growth. At the same time, you're starting to see prices rise, and sort of what does that do to asset allocation and that type of framework, particularly when you're so used to a framework where you had Fed support seemingly every step of the way.
And maybe this is the age-old turn of phrase that everyone takes from Warren Buffett, and of course was used by John Rogers earlier. And it doesn't matter whether you're a value or a growth stock investor, you've got to be perhaps a little bit gumption, a little bit of greed when others are fearful. And we'll see whether people start to take that.
Yeah, and at the end of the day, this idea of classic valuation coming back in a market that's been dominating by day traders and meme stocks for so long. But as the Fed starts to taper, then does reality start to hit a little harder? And, you know, is it stagflation or just really this idea of a decelerating economy is what Kyu-Sung Lee had said was his biggest risk?
Yeah, this is setting up a good battle. Taylor used to be my adversary when the inflation versus transitory debate. Now it's stagflation. Caroline, we're now adversaries.
Oh, well, I like a good old debate. We make it personal, though, Remy. Coming up. You could break us up, Shonali. Meanwhile, we break down the big themes from Bloomberg Invest Global Conference with Nick Haser. He's Bloomberg opinion columnist. This is Bloomberg.
Something wrong with her eye. And when I had a look, it looked like she was blind. The vet that she's registered with were only doing telephone appointments, which was a bit pointless because she really needed to be seen by someone. And I couldn't get one anyway for like another week. I was just quite worried about, you know, the complications of leaving it for so long.
We've seen millions more animals becoming pets in the past year due to the people having increased time at home. What we're also finding is due to Brexit that we're having decreased numbers of European vets working over here. So unfortunately, we're unable to meet that current demand for pet services. Also, COVID's got the inevitable impact with people having to self-isolate.
It is very limited what we can diagnose, so it's more about peace of mind and determining whether they do need to be seen in person.
All right, we've been talking about the Bloomberg Invest Global Conference. We had 2 days of it here. It was an amazing day. We're going to have a third and final day tomorrow. It focuses a lot on everything that's driving institutional investment strategies. We've been talking a lot about it here on the show, and we want to continue that conversation right now with Nir Kassar, Bloomberg opinion columnist, joining us right now. Nir, I want to start off with, how do you sort of allocate assets in a world where everything is expensive, in a world where you may get some sense of normalization of monetary policy, in a world where, okay, fiscal policy may actually either aid or hinder the process?
I don't know, man. I think it's a very tricky question. And I think the first thing that has to happen is investors have to acknowledge that it's going to be a lower return environment going forward than it has been in the past. You know, if you look at U.S. assets in general, they're expensive. You know, wherever you go, bonds, stocks, private assets. If you look at bonds around the world and you look at credit in general around the world, spreads are thin. And so then the question is, what do you do? I mean, I think it's sensible to say I'm going to diversify, but I think the real danger is not accepting the fact that ultimately you're probably going to have a return of somewhere between 4 to 6% nominal, it seems to me, if you just line up expected returns. And you can take it or you can swing for the fences. And I think that's where the real danger is. And I would encourage people not to do that.
Yeah, not to swing for the fences, not to perhaps go for the bright, shiny objects. That's certainly something John Rogers over at Ariel Investments was saying. Like, he's worried about certain areas that are bubblicious, whether it be, you know, crypto, whether it be meme. He's still finding value in certain value stocks. But where do you stand on the what even is value debate near at this current stage?
I personally favor the academic view of value. I don't think it has to be that complicated. I think if you sort, your stock markets on any sort of traditional value measure, whatever you like, price to earnings, price to cash flow, price to book, I think you're gonna find a big difference between the stocks that end up in the value camp and the growth stocks. And it's not that value in the U.S. is particularly cheap, although it is, I think, outside the U.S. It's that the valuation gap, on however basis you want to do it, is very large between value and growth in historical terms. And I just think that valuation gap is going to shrink because ultimately I think that valuation gap was created to begin with on the back of earnings growth over the last decade, let's call it 15 years or so. That was huge and unsustainable in historical terms.
This is so interesting as you have so many private equity firms in the world pushing into growth, right? You have KKR, Blackstone, Carlyle, at a time where what you're saying is the old strategy, that Warren Buffett strategy that they had followed for so long may have worked better. What does that bode for private asset returns moving forward?
I mean, private assets are interesting because it seems to me that the valuations are quite high. We don't have as much historical data on private equity. Maybe it goes back to the 1990s, but the valuations there are as high as we've ever seen. And you can understand why, people, going back to Romaine's question, people don't like the returns they're seeing from traditional assets. And so they're piling into private equity. But ask yourself, as those valuations go higher, what is that going to do to expected returns? It's going to go down. There's another thing about private equity that, unlike the traditional assets, you're talking about a sector, you're talking about a corner of the investment universe that's very highly levered and where disclosures are a little bit more opaque.
Yeah.
So now combine that with high valuations and you've got a cocktail that's interesting.
Well, I'm curious on that point, Nir. I mean, we talk a lot about valuations in the equity market and the visible part of it, the public equity market here. There's also been a lot of talk here that there are sort of bubble conditions in some corners of private equity right now. And I'm wondering, is there sort of any way that investors could sort of suss that out on their own here, given the information disadvantage that we have right now with regards to what's actually in some of these funds?
I think it's very difficult, Romaine, because it's already opaque to begin with, but it's just that the information is not as widely available on private equity as as it is on public markets in general. And thankfully, I shouldn't say that. As you know, I'm a big believer that everyone should have access to private assets. I was going to say, though, that because, the gates being what they are in terms of the securities laws in the U.S., a lot of people don't have access to private assets, so it's not even an option for them. But I think two things that we should do is we should open it to everyone, and also we should open the information flow so that we can look at these numbers and we can say something intelligent. But I think it's safe to say that with U.S. assets, everywhere you look where they are, private equity is probably no exception.
It's interesting that you're talking about, of course, almost the democratization of investment there. And to a large extent, this buy-the-dip mentality that seems to have come to the market's rescue a couple of times this week and before, is that coming from retail? Is that coming from institutional money? What's driving it, do you think?
I think it's probably a bit of both. There's been, certainly I think retail is there. And I wish, by the way, I had better data on this. I think retail is there because retail has piled into this market in a big way in the last couple of years, as you know. But also, I think you do have a problem of where do you go? Ultimately, there's going to be some rebalancing when markets sell down. And so you're just going to have an automatic amount of buying risk assets. Mm-hmm. But particularly in this environment where, if I were to say to you, you're going to take a lot of risk, you're going to have a bumpy ride in stocks, and ultimately you're going to get a 3 to 5% return over the next 10 years, you're probably going to say, I don't like that, but I like it a lot better than 50 basis points from treasuries. And so I just think that's putting people in a situation where it's risk assets or bust.
Nir, should we all just be extraordinarily worried about our retirement funds at the end of the day?
I don't think so. For most people, because what we're talking about here really is cyclical factors, right? And for most people, they're going to put their money away. Hopefully it's going to be invested for 30 or 40 years. And the truth is everything washes out over 30 or 40 years. You might not get the same returns you got over the last century from U.S. stocks and maybe other assets, but you're going to do fine, and it's still the best bet. So I would encourage people not to pay attention to the short-term noise. Put money away for the long term. Do it in low-cost index funds if you can, and it'll serve you well.
Okay, well, that was my next question. Going back to the debate over passive versus active, we spoke to a lot of active fund managers today, and they definitely extolled the virtues of active management, particularly in an environment like now here. You think a passive strategy over the long term, that's still going to be the winner?
Well, it depends on how long you look. I mean, my guess, Romaine, is that if you look long enough, if we're talking about decades, that, in general, I think, market indexes that track the market are going to do best for the majority of people, and they're still going to beat 80, 90% of active manager. Having said that, I do think that the opportunity set potentially for active managers today is as good as it's ever been in my adult lifetime. And the reason I say that is because of these huge valuation gaps that have opened up in the market, and where I think you're going to have better opportunities in some corners of the markets than others. A good active manager will sharpen his or her pencil and give you exposure to those stocks, and I think that will pay off over the next, let's call it 5 to 10 years. But for most investors, they're not looking at 5 to 10 years. They're looking at very, very long periods. And for them, I think ultimately, the broad market indexes will be as good as anything.
Yeah, okay, so on Bloomberg Opinion, thank you so much. Stay well. Great analysis throughout of all of that. And we're going to dig in a little bit more deeply into what the volatility is meaning at the moment for certain new entrants to the public offerings, to public markets, in fact. We're talking about whether, some of these SPACs, some of these IPOs are getting put to one side. This is Bloomberg.
They know me as Magnus TV in Facebook since I'm streaming Axie Infinity. Axie Infinity is an NFT game where you can earn tokens, and then that tokens can be converted into pesos. I started it. I'm playing almost 4 to 5 hours a day. I'm earning, I can say it's really a lot of money. It can help to sustain my family needs and also to sustain my own business that I'm starting. I'm a little bit worried about it because some people who join this Axie Infinity thinking that this is an easy money game. They can earn a lot on this game. This game can sustain their life, and I think that is not the point, or that is not really the game. We are trying now to build a community where other players or my scholars can join this esport, playing Axie Infinity for example, even 5 years, I think.
How far will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet.
We might be.
That gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh, my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
Today, we're focused on what we learned from the Bloomberg Invest Global Conference and, of course, what we're going to learn tomorrow as well. But what's being said about the current investment climate right now is a trend that we keep seeing is, well, more and more IPOs that are actually being pulled back. Are we turning cautious? Are we facing choppier markets? It's certainly something that I know you've been keeping an eye on. Should we get Shonali on her VIX index?
Oh, I love this VIX conversation and the clamping down of IPOs. But honestly, Caroline, it's IPOs. There's a big pipeline in October. So, Crystal, joining us now is Crystal C., who covers IPOs for Bloomberg. Crystal, what are you worried about? I mean, this is what you follow all day.
It is what I follow all day. So we have seen some pullback actually globally in Asia as well, in Europe as well. There's been deals that are not pricing, delaying the deal. But we are also seeing a bunch of deals still coming forward. The bake-off activity is not as strong at the moment. So a lot of pipeline.
I love that you just weaved in bake-off.
The bake-off.
Exactly.
Not dissimilar to the Great British Bake Off.
It's not.
It's not. But look, I mean, when you have these short-term market moves, it obviously spooks people maybe for a couple of weeks. Maybe they put off a deal. At some point, though, they usually come back to the table pretty quickly once market conditions improve. Is there a general sense here that the longer-term outlook for a lot of these deals, it's still intact?
Yeah, it's very much so. The pipeline is still very strong. Like the deals that have filed and the companies that have hired banks, there are so many of them. We probably need more than like the remaining of the quarter to go through. And we are seeing some deals facing challenges, but there are even bigger deals that are still in the market waiting to tap investors. And today there are two pricing, for instance. So we're still seeing activities. It's probably a little bit like pullback on valuation.
Okay, so yeah, if you are going to get your deal done, if you're still committed, are you having to reduce the premium that you were previously putting online? Are people being more cautious about the valuation that you come out of the box?
Yeah, the discussions with investors is getting more difficult, right? Like they are getting more selective and they are tougher on valuation, and that has been true the past few months. Though there are sectors that still do well. If you're like a tech company or if you are a healthcare
like growth?
Well, healthcare is doing extremely well. Some sector within consumer, like Olaplex, hair care product, those have done very well. So there are pockets that are still working.
Olaplex went public?
Yes, you were in Italy.
I was too show about it.
I was too busy using it in my hair.
Warby Parker's also had done
it's
really
funny.
well.
I never heard of Olaplex before they came public. Now I see it everywhere. It's
Wait,
like
they are everywhere.
Yeah. That's a big thing. Are there any other shampoo companies going public?
Well, it's not just shampoo. They're saying that hair is a revolution, right?
Hair is a revolution?
Hair is a revolution. You're expressing yourself, and there's so much you can do. You have moisturizer.
Speaking of boisterous comments, how's WeWork doing?
Well, WeWork is still going through the SPAC deal, as far as we know. So that evaluation has drastically come down compared to.
Remember when WeWork was a revolution? Now it's just hair.
Now it's just hair. Now it's just where people go to work. Crystal C. Great. She always makes it fun.
Can we get her back on to talk about the Great British Bake Off?
Yeah.
Like we need a whole 30 minutes with just her.
Just her on a hair revolution and the revolution that is British baking.
News.
Then we can get into remains.
That Bix ticks higher.
Well, and the Great British Bake Off does too.
Closes down. Yeah.
Don't try and tell me there's any correlation in that. But what we do know is that the British, they're quite good at baked goods. They're also good at pottery, according to Romain.
Are they? Yeah. Interesting.
But seriously, guys, one thing we didn't get to talk about with Crystal was this great interview she had with Betsy Cohen, a SPAC queen, saying that 30% of SPAC deals can not work out at all, and that's another thing that can clamp the market down.
Yeah, I saw that interview with Betsy, and I talked with a couple people during the Global Invest Conference about this as well. They made it clear, look, if clients want something, they'll find a way at least to, I guess, accommodate them. Is that the word?
Fees at the end of the day, Romain.
Crypto.
No, people aren't liking crypto.
Exactly.
No.
Well, John Rogers wasn't liking crypto. The rest of the world liked crypto today. What was it, 55,000 on Bitcoin?
55K. It's a real rally.
That does it from what you missed. Bloomberg Technology might talk about crypto. It's coming up next.
Yeah. Have a great evening, everyone. This is Bloomberg.
OECD nations need to end coal use by 2030. Developing nations need to follow suit by 2040. And we need coalitions of solidarity between countries that still depend heavily on coal and countries that have the financial and technical resources to support transitions, because it is essential that no more coal power plants are built.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The worst is over for this pandemic, that we have passed the peak, if you like, in your own words, that the recovery will continue. It may be slow, it may be bumpy.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
From the heart of where innovation, money, and power collide, in Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Zuckerberg responds, the Facebook CEO, saying simply it is not true that the social networks put profits over people, saying he doesn't recognize the company whistleblower Frances Haugen has described. But he agrees regulation is needed. What could and should that look like? We'll discuss. Plus, Amazon's video game streaming platform Twitch has been hacked, exposing source code and how much money creators are making. The hackers' motive? To spark competition in game streaming. We'll have the details. And when Amazon founder Jeff Bezos bought 100,000 vehicles from Rivian, it was a defining moment for the electric truck maker. Why Bezos was so intrigued and the fascinating way he learned about the company later this hour. We'll get to all of that in a moment, but first I want to take a look at the market. Stocks whipsawing in heavy trading as Republicans were poised to offer Democrats a way to end the debt limit impasse. Our Ed Ludlow joins us now with today's moves. Ed, walk us through the day.
Yeah, we were down more than 1% at one point in equity markets. But you can see pretty clearly we ended in the green. The S&P 500 up by 0.4%. There was outperformance in technology stocks. The tech-heavy NASDAQ 100 up by more than 0.6%. There's been concern, as you know, Emily, about those kind of mega-cap high-growth tech stocks, the big names, Apple, Amazon, Microsoft. But the NYSE FANG Plus index up by 0.8%, and even semiconductors, which have been down right until the end of the session, ending in the green. Come with me into my Bloomberg terminal. You and I have been discussing some concerns about whether we get a correction in tech stocks. But if you look at the NYSE FANG Plus index, it's trading at 28 times estimated earnings for this coming year versus about 20 times estimated earnings for the S&P 500. That is the narrowest premium since December 2018. And if you remember December 2018, Emily, we bottomed out on tech stocks and then had a huge rally that set into motion several consecutive record highs. So the narrative around markets has really changed. I want to talk a little bit about cryptocurrencies as well, because frankly, we're on the march. If you take the Bloomberg Galaxy Crypto Index, we're up by around 30% over a 5-day period, 5 consecutive days of gains, the best run since May, and Bitcoin, a big driver of that. We know we crossed the $55,000 mark on Wednesday. Some growing bullishness that this is a climb higher that could be sustained for cryptocurrency. And finally, 2 stock movers that I want to touch on very quickly. The first being Electronic Arts, down by 7.4% or 7% on Wednesday, its biggest drop since November. This is about Reddit forums users pointing out on Reddit that the beta version of Battlefield 2042 has bugs. The power of the Reddit forums. Astonishing to see that drop. And Moderna, down 9%. Of course, countries like Sweden and Denmark are putting the Moderna vaccine for COVID-19 on hold due to concerns about some side effects, particularly in younger people. Two stocks to watch for the rest of the week. Emily.
All right, Ed, thanks for that. Well, the idea that Facebook puts profit over people's safety and well-being is just not true, says Mark Zuckerberg in a lengthy Facebook post defending the company Tuesday night, hours after whistleblower Frances Haugen testified in front of Congress. Let's talk more about what it means for the future of Facebook and potential regulation with my next guest, Daphne Keller, Platform Regulation Director at the Stanford Cyber Policy Center. Daphne, thank you so much for joining us. I want to read a little bit to you of Mark Zuckerberg's statement. At the heart of these accusations, this idea that they prioritize profit over safety, he says that's simply not true. He adds that the reality is that young people use technology. Rather than ignoring this, tech companies should build experiences that meet their needs while also keeping them safe. The problem is that Facebook, to a large extent, has lost public trust. I'm curious, Daphne, what your reaction is to Zuckerberg finally coming out and responding to Frances Haugen's allegations directly.
Well, so I'd start by saying I think Facebook is full of people like Frances Haugen. It is full of people who care very deeply about potential harms of the platform and who are working hard to correct them. And I think in Zuckerberg's message, he got one thing really right, which is that those people need to have the freedom internally to do research and to maybe make mistakes and share their findings internally without fear that that's going to become some kind of journalistic gotcha. So I do worry that in a way this will disempower those people. But those people also exist alongside executives who, according to reporting from the Wall Street Journal and elsewhere, have done some frankly disturbing things, like the executive in India who overruled the trust and safety team to leave up posts that incited violence because they were from politically connected people. And those impulses, the desire to really, do the right thing and make the platform as safe as possible, and the impulse to seek profit and be politically accommodating or sensitive are always going to coexist inside the company. The question is how to strike the right balance. I'm not sure if Zuckerberg's message has reassured his employees that that's going to happen.
Let's take a listen to one of the moments from the testimony yesterday where Frances Haugen outlines Facebook's problems and then describes the company as being trapped. Take a listen.
Facebook is stuck in a feedback loop that they cannot get out of. They have been hiding this information because they feel trapped, right? Like they would have come forward if they had solutions to these things. They need to admit they did something wrong and that they need help to solve these problems. And that's what moral bankruptcy is.
I'm curious, Daphne, what you think of this idea that Facebook may be filled with a lot of well-intentioned people who may be in over their heads. Maybe Facebook's problems are just too big for any group of people to solve.
Yeah, so journalist Mike Masnick called this the banality of hubris, that we are seeing in this report's problems that anybody who was paying attention knew were going on with Facebook in some form all along. It's just now we have documentation of the details. And I don't think that Facebook alone can solve them. I think that with better transparency and better input from civil society organizations, from experts, from members of marginalized communities who have been reporting harms like this for years and years, we can arrive at better solutions. And, having a whistleblower force that transparency onto them probably wasn't the optimal way to do it, but we need that transparency. And now we have a better idea what's going on and better opportunity for more input.
Would you say that Facebook is too big to govern or ungovernable? I mean, obviously, Facebook is bigger than the biggest countries in the world combined. Is it just too big?
It is not too big to govern. It is subject to privacy regulations in Europe. It is subject to obligations to take down certain kinds of content in every country in the world, including the United States. What it might not be able to do is perfectly regulate all the online speech so that all the good things stay up and all the bad things come down. That's partly because none of us can even agree on what that would mean. But it's also because no government in history has undertaken to police people's daily speech in the way that we are asking Facebook to do. That's a monumental task.
So let's start with the U.S. government. Should the U.S. government do that? And if so, how? I mean, one of the most remarkable moments in the testimony yesterday was senators from both sides of the aisle agreeing they have differences, but those differences are minor compared to the issues that Facebook, they believe, is causing.
So I don't think there are a lot of great options for new top-down regulation from Congress saying what speech should be allowed on Facebook or how Facebook should amplify that speech. And this is because so much of the harmful or dangerous speech we're talking about is protected by the First Amendment. You know, it might be disinformation, it might be hate speech, we might find it morally abhorrent, but Congress doesn't have the power to regulate it unless the Supreme Court changes its law, its interpretation of the First Amendment. What Congress does have the power to do, though, is to pass laws grounded in competition or grounded in privacy. And I actually think there are ways to get at these content issues by, for example, giving users more control over how their data is used and more dials and knobs to adjust what they're seeing in their Facebook feed. Or you could try introducing competition in the provision of content moderation on top of Facebook. This is something that my Stanford colleague, Francis Fukuyama, has called middleware, you know, creating competition where users can choose to have a flavor of Facebook that prioritizes what their church wants prioritized, or a version of YouTube curated by Black Lives Matter affiliated groups. There are things we can do using privacy and competition to avoid having top-down speech regulation from Congress.
The leaked research from Frances Haugen also reveals a disconnect between Facebook's devotion of resources to the United States and to fighting misinformation and hate in English and the resources it devotes to the rest of the world. And Frances Haugen pointed out that Facebook's technology is particularly bad when it comes to identifying some of these issues in languages that aren't English. How big a problem is that?
I'm so glad you're bringing that up because it's a huge problem and it's something that doesn't get enough recognition from the US Congress, unsurprisingly, but that is no surprise at all to civil society activists from around the world or ordinary users around the world. You know, people in places like Myanmar or Sri Lanka or Kazakhstan are getting an experience of Facebook that is worse than the experience of Facebook that you or I are getting. And that's both because of insufficient support, you know, from employees who speak the languages in those countries, or the sometimes multiple languages in those countries, but also because of the difficulties in updating the algorithms to have the sort of greater safety measures that Facebook has implemented for English, Spanish, French, major languages like those.
Where do you think Facebook is headed if nothing changes, if no regulation is put in place?
Well, that's not going to happen. You know, even if Congress is paralyzed in the US, the EU is passing a major new law, the Digital Services Act. It will definitely come into effect. It will definitely reshape content moderation practices. It will require Facebook to do annual risk assessments and mitigation plans and independent audits. So change is coming no matter what. And this is one of the reasons that Facebook is running ads saying, please regulate us. You know, their sort of best case scenario of the future is if the US requires them to do the same things that Europe was going to require them to do anyway. And those are things that its smaller competitors can't afford to do.
So then do you think some of the sort of doomsday scenarios, there are a lot of people on both extremes of this debate, are they overreacting to what we've heard over the last couple of weeks through Frances Haugen?
I don't think they're overreacting. You know, I think particularly if you hadn't been tracking these issues and all of the things that Frances revealed are news, then it is appropriate to say, hey, this is a big deal. We should do something about it. But in terms of what are our options going forward for wise regulation, they're about the same options that we had before. And there are always limits from the First Amendment on one side to what Congress can do, but also from just the operational reality of platforms on the other side. There's not a magic wand that anyone can wave and make Facebook moderate content in a way that make all of us happy.
All right. Daphne Keller, Platform Regulation Director at the Stanford Cyber Policy Center. Daphne, great to have you and appreciate having a nuanced conversation on this. Coming up, from nicety to necessity, the grassroots site Down Detector has exploded in popularity thanks to Facebook's global outage on Monday, the largest outage ever for the social network. We're going to have more coming up next. This is Bloomberg.
Natanggap ko po ang inyong nominasyon sa akin bilang kandidato sa pagkapangulo ng Republika ng Pilipinas. I am a fighter, and I will always be a fighter inside and outside the ring.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The growth story in cannabis remains very strong even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
Snapchat was the biggest winner when Facebook had its worst outage in years. Monday, Snap saw a 23% boost in time spent on its Android app compared with the same day the week before. Telegram and Signal also recorded a big surge in usage. And the first site to detect Facebook's global outage was Down Detector. The site has become a go-to hub for outage reports across the web. From Facebook to TikTok to Disney Plus and Hulu, Down Detector provides real-time user-reported status updates on whether a website is functioning properly. For more, I want to bring in Bloomberg News cyber reporter Kartikay Mehrotra. And Kartikay, this wasn't only the biggest outage for Facebook ever, but the biggest outage that Down Detector ever detected. What did it look like from their end?
Yeah, that's exactly right. So they first were notified by their own consumers, right? Individuals who consume the data of Down Detector reported to Down Detector early in the morning that something's wrong with Facebook's site, with Instagram, with WhatsApp, and very swiftly they sort of stumbled upon this critical mass where they saw 100,000 complaints coming in very swiftly, and that triggered an automation in their system that sent out a tweet and messages saying clearly there's something wrong with Facebook. And so they sent out tweets saying Facebook's down, Facebook Messenger is down, Instagram and WhatsApp. And within minutes, the world knew that something was very wrong with Facebook's platforms.
Now, Facebook has underscored that this wasn't the result of a hack or anything nefarious, though there are certainly conspiracy theories floating out there. But what did we learn from this particular outage and what it means going forward.
Yeah. So to be clear, what we learned didn't come from Down Detector, but what we have learned is that there was an internal snafu at Facebook. What happened was they have there's a critical protocol on the internet called DNS, Domain Name Systems, which allows a user to type in a name into a URL or open an app, and DNS converts that name into an IP address, and that is what loads the website that you and I look at. But that system was not working because another protocol called Border Gateway Protocol, which is basically like the postal service of the internet, had also stopped working. The paths that the DNS system might take to load the site didn't exist. And so it was every time we were loading the pages, we were running into a dead end. What we don't know yet is exactly why those BGP Border Gateway Protocol systems were not working, why they'd been withdrawn by Facebook. Was it because of the DNS issue, or were they having broader network problems? We're still sort of waiting for an explanation of exactly why these critical systems weren't working.
So how is Down Detector viewing this outage in the context of other outages it's seen and for the future?
Yeah, so as you mentioned, this is the biggest outage